There are big changes coming to Fannie Mae and Freddie Mac loans this May 1st. To say that a lot of people are angry about these changes is the understatement of the century. But what are loan level price adjustments? How are they changing? And how will this affect your next loan? Today I talked to Larry Ashton from Great Rates Home Loans. This is the Market Brew. So here we are today with Larry. Larry, how you doing today, man?
I'm doing great today. How are you doing?
Well, I've been better. This big change is coming up with Fannie Mae, and I'm a little worried about it. So can you explain a little bit what's going on here, and why are people so angry about it? I mean, what do they think is happening here?
Well, you're probably referring to what we call the LLPAs, and those are the loan level price adjustments. And basically, when we look at a home loan, whether it be Fannie Mae, Freddie Mac, FHA, VA, or even non-conforming, they're what we call risk-based loans, meaning they look at the people borrowing money and they assign risk based on down payment, credit score, income levels, type of property. And there's some new changes coming out. Pretty much they're already in effect, and they're gonna turn some of that a little bit upside down to where a person maybe with a lower credit score and a lower down payment based on their income can maybe get a better rate than somebody with a large down payment and 800 FICO scores. And so there's a lot of stuff in the news about that right now, and it is frustrating people, as you mentioned.
Okay, so I'm not the brightest person. So can
let's not be
can you explain what the loan level price adjustments are to the layman?
Yeah, I sent you a chart. You might want to show that real quick, but basically, based on these different risk-based criteria, there are matrices. And so one of them will be, okay, if you put 3% down, we're going to adjust your rate this much, 5% this much, 10%, 20%, 30%. And there's a matrix for that. And that matrix isn't just based mainly on your down payment, but also your credit score. Oh, yeah. So in the past, the higher the risk of the loan maybe going into default, the more expensive it would be to the consumer. And they called that risk-based pricing. And
so it's like insurance to Fannie Mae.
Well, basically what they do is they look at a pool of loans and they say, where are we seeing the most defaults? And typically they will see more defaults with people putting low payments, lower down payments, and lower FICO scores. As a general rule, let's say somebody puts 50% down on a home loan, even if property values pull back a little bit, most people aren't going to let their home go into default when they have equity. So that down payment kind of suggests to the lender and the people, lenders and the people looking at risk that, we could have a large pullback in real estate, but these people are still going to make their payments or sell their home, so odds are we'll get our money back, as opposed to the person who puts 5% down, maybe has rough credit, a history of not making their payments as well. They're going to look at that and say that's a higher risk loan.
So how are these changing May 1st?
Well, to a certain degree, what's happened is the powers to be said we want to make lending and home ownership more affordable for people with lower incomes. And for them to do that, and remember, there's a pool of loans out here, okay? For them to do that, they have to make it less expensive for those people to purchase homes, and knowing that a lot of them will still, or a higher percentage of them will go into default. And so what they're doing is they're taking these loans that would maybe be at this end of the spectrum, and to cover the potential losses, they're making it a little bit more expensive on this side of the spectrum. And so many people feel that that's punishing the person that has a high credit score versus the person that doesn't have the high credit score.
So they're passing the risk onto the stronger borrower.
Yeah, there was a term once I heard in the medical industry called cost shifting, and that's where when somebody goes into the ER room, if and they have insurance, they'd maybe charge them more than they want the person without, so that they can cover the losses. I'm not saying anybody does that. That's a theory.
Yeah.
Because I don't want people sending me
And
hate mail,
we know
but,
how great our healthcare system is. So.
So yeah,
Okay.
so that's what has people frustrated with the system.
Yeah.
I don't want to try to make a positive out of something that is going to cost people more money. In the big picture, yes, it is going to cost a little bit more money. Should that make the person with a good job and a good down payment, wants to own the home, say, no, I'm not going to buy one? I wouldn't think so.
Okay.
But it is going to be a little bit more expensive on that.
So this program's not going to be bad for everyone. It's going to be good for people with lower FICO scores. And what else?
Well, let me preference that. So the adjustments on the FICO scores are somewhat minimal. To get these loan level price adjustments waived, it's going to be more income based. Okay. So this is a real important feature. So the news I've been watching, people talking to me are thinking it's really all about credit scores, when really it's more income driven. So if we take Ventura County, for example, the AMI, or the average median income, is around $115,400. So if a person makes that or less, lending will become more advantageous to them.
Is that for a single or for a couple?
That's for the cumulative of the people on the application.
So just anybody, okay.
Yeah, so that brings up a really good point, because we talked about this a little bit. When the real estate market's hot, you could have mediocre real estate people selling property because the market's hot. It's kind of like that in lending. When it's not as hot, that's when people need someone with your expertise to guide them, because the market's changing. And it's kind of the same thing with lending. So if you, for instance, have two people going on the loan and they have low credit scores, as long as one of them can qualify without the other person, it may make sense for just one of them to go on the loan. Another example would be a person that receives bonus income. We may be able, because we have a couple different ways we could calculate that, we may be able to legally, without violating any lending laws, show their income in a way that's acceptable to Fannie Mae, and then also gets them below this AMI number that we're talking about.
So you need a lender that knows what they're doing to.
Yeah, I would say a lender and a realtor, because it's all going to be tied in together. So most people buy a home based on their comfort level, not necessarily what they're going to qualify for. So the less expensive we can make the loan, the better we can make the interest rate, the more a home they can afford and still be in that comfort level, which then comes to your part of the game, where you match them up with homes, hopefully that meet their criteria of what they're looking for, but then also are within that comfort level also.
That's the goal, right?
That's the goal. Is we want everybody to be happy.
So I've had phone calls since this has kind of come around, and people have been asking me if it would be beneficial to them to purposely basically bomb their credit score in order to receive a better rate. And I feel like that's a terrible idea, just, off the top of my head. What do you think?
So one is, purposefully lowering your credit score is not going to get you a better rate. Okay. So when we look at the matrix flows up and down like this, and it flows this way and this way also. With a person putting 5% down, the rate gets worse and worse as their credit score gets worse and worse. Okay. So there could be an advantage where somebody might say, I'm going to put 5% down instead of 15% down, and then I'm going to take that 10% and pay off my car and some other debt. So it could benefit them that way. But again, the things people need to remember is that this is more of a income-based change than it is now. Yes, they did make it more expensive,
Uh,
but what they're doing is if you're at these income levels, that's when you get the benefit of the waived fees. Okay, there's that's where the big difference comes in. It's all based on this income.
okay.
And so, one of the questions would be, hey, can somebody, at $115,000 still buy a home, in Ventura County? Well, at 115,000, you could probably have a house payment around 4,500 a month and still qualify. And
Hmm.
I believe under many circumstances that would get you into an entry level home.
Yeah.
Okay, so the key is if we can, without breaking the law, get a person's income down to that AMI level, then
Hmm.
they're actually going to get the benefits. Where it's going to hurt the person the most is where their income's higher than that 115,400. And let's say they're making 150, 180, and they want to put 10% down. Those people, it is going to be more expensive for them. Not
Okay.
enough to kill the deal, but
Yeah.
it is going to be more expensive.
Very, very well spoken and very good description of what the situation is that we're going to be moving into May 1st. Thank you, Larry, for coming on again. It's always a
Oh, my
pleasure.
pleasure. Thank you.
All right. I'll see you next time then. Well, that's it for today. I'll see you next time. And as always, I'm never too busy for your referrals.